If you've started selling covered calls within the last year or so, you've probably noticed that the size of your premiums has gotten smaller over the past few months. And there are a few reasons for that, which we'll get into in this video, but more importantly, we're also going to talk about how you might need to adjust your strategy in order to continue bringing in as much premium as possible. So let's get into it. My name is Charlie, and on this channel I make videos about building wealth and achieving financial freedom so that you can free up your time to focus on the things that you truly care about. So as I've mentioned, call premiums right now are a bit lower than what we've seen over the past year or so, but really I should say that they're back to normal because the high volatility that we saw in 2020 led to higher than usual premiums, and it's really just now over the past few months that it's starting to settle down a bit. And as most of you probably know, volatility is the main factor that determines how high your option premiums are going to be. And when we're talking about covered calls, we're mostly interested in the volatility to the upside, or in other words, how quickly stocks are rising. Because of course, if a stock is rising very quickly, option buyers are willing to pay higher prices to buy call options on that stock. So a useful tool that you can look at to get a general idea of where volatility is at in the market is the CBOE Volatility Index, which is ticker symbol VIX. So essentially it's just an index that aims to track volatility in the market, and we can see that currently the index is at its lowest level since February 2020. And that's the main reason that we're seeing lower covered call premiums, because if you had started selling covered calls in March 2020, for example, you would have been collecting massive premiums, not to mention plenty of capital gains as long as you were selling out of the money calls. But ever since about the end of March 2021, that volatility has kind of come back down to earth, and therefore call premiums have returned to more typical levels. Then in addition to all of that, uncertainty in a stock contributes to higher premiums as well. So if a stock is very uncertain, that means there's a good chance that the stock can move up or down very quickly and unexpectedly. So again, option buyers will be willing to pay more to buy options on stocks like that. Because just for example, if you have a stock that's almost certainly not going to increase in price within the next week, option buyers aren't going to want to buy out of the money calls on that stock because those calls will likely be worthless by the time they would expire. And therefore the premiums for selling those out of the money options will be lower because no one's willing to pay for them. So it's really just all supply and demand. But just because premiums have died down a bit doesn't mean you can't still bring in great income selling covered calls, and there are a few things that I'm personally doing differently right now in order to still maximize my premiums. And the main thing is just selling calls further out in time. So usually I prefer to sell calls that expire in just about 1 or 2 weeks in order to maximize the premiums that I bring in, and also because that allows me to adjust my strike prices more frequently so I can avoid missing out on as much upside as possible. But in today's market, I actually prefer to sell my calls a bit further out in time, more like anywhere from about 2 to 4 weeks out. So this allows me to lock in a bigger premium up front, and I don't have to worry as much about short-term fluctuations in the stock. Plus, since there's less volatility in the market these days, it's less likely that one of my stocks will rise extremely quickly within a 1 or 2 week period, so I'm okay with limiting my upside for a bit longer in exchange for locking in that higher premium. Then on the same note, I've also been selling calls a bit closer to my cost basis, or in other words, not as far out of the money as usual. So for example, on a stock like Apple, I might sell calls only about $1 above my initial purchase price rather than my usual $3 to $4. Because again, since the market isn't really racing forward right now, I'm not too worried about missing out on upside by selling calls closer to my cost basis. And seeing that most stocks are hovering around their all-time highs right now, I think we'll continue to see some occasional pullbacks throughout the year. So if I can hit my goal of about a 2 to 4% return on premiums every single month, I'll be happy with that. And this is certainly pretty easy to do even when stocks aren't racing forward. Now another strategy I use is to sell calls on a combination of some volatile and some less volatile stocks. So usually I prefer to sell covered calls on mostly established Dow components like Apple, Microsoft, and Nike, or at least on stocks that pay a dividend like Target and TSM. And while those stocks are great for stability in your portfolio, they don't yield quite as high of premiums because they don't tend to be as volatile. So when call premiums are on the lower side like they are now, I also like to add in several stocks with higher implied volatility. And these are going to be stocks outside of the Dow Jones Industrial Average that don't pay a dividend, although I do like to stick with stocks within the S&P 500 whenever possible. So right now, these are stocks like AMD, Chewy, PayPal, and Square, and of course they all yield higher premiums, but that's because they're more volatile and risky, so you don't want to go overboard with stocks like this. Personally, I like to stick with about half of my covered call portfolio being those more established, stable companies. Now, the last strategy I'm using to maximize the premiums that I bring in is selling naked calls and or setting up bear call spreads. So these strategies allow me to continue collecting premiums even if the market goes down, and in most cases, I never even have to buy any shares. So the way I set them up, it's actually nearly impossible to lose money no matter what happens with the stock. And if you're not familiar with that strategy, be sure to check out my full tutorial in the bottom right corner of the screen. So thanks a lot for watching, and I'll talk to you in that next video.